Hi, everyone. My guest today is Evan Tindell. Evan is the co-founder and CIO of Bireme Capital. Is it Bireme Capital?
Yeah, you got it right. Yeah.
Okay.
Sometimes
Um,
I've heard Bireme, I've heard Bireme, I've heard all sorts of.
I was curious, what is a bireme versus a trireme? Because I've heard of a
A
trireme. I've never heard
bireme,
of.
yeah, a bireme has two sets of oars, and I think it's supposed to be a little bit more like maneuverable. And it's me and my partner, so it's like there's two of us rowing together. That I think that was
I
kind of
thought
it.
the images on the site were badass.
I guess if we ever hire an analyst or another partner, maybe we have to change it to trireme. We'll just keep going up the.
Well, Evan is the co-founder and the CIO there, and I invited him on because I enjoy his Twitter feed and I've enjoyed his write-ups on their website. Evan also has a unique background. He went to MIT and he was also a professional poker player for 3 years and has sizable live earnings. And I just wanted to have you on to discuss poker and investing and your sort of intellectual journey in poker and investing in both those things.
Sure.
So thank you for being on.
Yeah, I appreciate it. Oh, my phone's gone off.
Oh, don't worry about it. I actually wanted to start with something that's kind of near and dear to me. Our investment strategy at my firm is very much based on the past, and this idea that you can learn principles from the past and apply them in the future. But what I was wondering about poker is, are there enduring principles in poker, or is it just entirely situational?
Yeah, there are a lot of. I mean, it depends on how deep we want to get, but there's definitely a lot of principles that are, widely applicable. Well, to both poker and investing. But I mean, there's like a core set of things that the average player gets wrong at poker, which like allows the good players to win, and those are definitely applicable to.
What are some of those?
Yeah, so and you'll see the kind of the obvious parallels to investing, but the first one is just patience, or like the willingness to not do anything. Like a lot of poker players are, some of them, sometimes they're having a few drinks, they're coming from the blackjack table, they're they're just there to have a good time, they're there to gamble, like they're treating it the same way they're treating putting money in the slot machine or whatever, which is they're there to gamble. They want it. They're not there to like play the game in the most strategically accurate manner.
Mm-hmm.
And so they're probably playing 50% of hands when they should be playing 20%.
Oh, interesting.
So like just that simple, like willing. I mean, most players aren't willing to just sit there and fold every hand for an hour.
Right.
Like
Totally.
Yeah, like when you think about it, if the appropriate number of hands played is 20%, and you're getting like 30 or 40 hands per hour. Okay, so you're going to play 5 to 10 hands per hour, which means some hours you might play no hands. Some hours you'll play 20 hands, some hours you'll play 3 hands, right? And yeah, but that's playing properly, and most people aren't willing to do that. And obviously, I mean, you see that in investing all the time, where people just have to be trading, they have to be like doing something, they have to be, they can't just own like boring stuff and just sit there.
Well, that's interesting, because I'm struck constantly. Something that we did at our firm that was really important to us was studying great investors, and we found about 85 people and looked in depth at what they did, and we were really struck by the degree to which they had sweet spots where they were either looking for things with huge payoffs, where it was a good business that had some predictability to it, or they just had a sweet spot in terms of industries. It's interesting what you're saying, that basically as a professional poker player, you have to wait for, what is it? Something like 1 in every 6 hand. There's only one at 6 or something like that.
It varies based on like how many people are at the table and things like that. Like if you're playing one-on-one poker, you have to play, 7, more than half of hands probably. But if it's at like a 9-person table or a 10-person table, then yeah, the percentage is closer to 20%. And of course, it's depending on the quality of the other players and things like that, it can be adjusted. But it's like it's never at a 10-person table. It's never going to be 50%, which is like what half of the people that go into the poker room end up doing. Is just like playing almost every hand.
That's really interesting.
And the other thing I'd say that people fail to do at the poker table, which is definitely like applicable to, I mean, it's applicable to anything, but poker for sure, and also investing, is they're not willing to. There's a sunk cost fallacy, basically, which is they're not willing to reanalyze the situation based on new information. Like they just, like if they have, and it's related to the desire to do things. Because like if you let's say you have been playing like properly and you wait for good hands, and then you get like a pair. I played mostly Texas Hold'em, which I'm guessing is what people are most familiar with. Mm-hmm. Let's say you get a pair of kings. So you're dealt 2 cards, you get a pair of kings. But then you have rounds of betting, and the board comes out. There's a flop to turn in a river, and sometimes when you start with kings, the action that occurs later in the hand tells you that you probably should be folding. Like you just have to let it go sometimes. Maybe 2 people are raising on the flop, and there's like they're going gangbusters or whatever, and you should fold. But most people, I mean, once they're like locked into the hand, or they raise on the flop, like they're just not they're just not properly reassessing as they go along. It's called like getting married to a hand. Mm-hmm. And you see that in I think you see that in investing as well. Like the disposition effect is like a common like bias that people have, where they sell winners too quickly and they hold on to losers because they're just like hoping that they're not willing to like reanalyze the situation and kind of like admit that maybe they were wrong. So that's another common one.
Were you at one point a quant?
I never was. My business partner, Ryan Ballantyne, he's like basically been a quant since coming out of college. I mean, going to MIT and and like studying like the history of value investing, like I definitely have an appreciation for the quantitative side of things, and how fishing in that pond gives you like a pretty big advantage historically. Mm-hmm. I mean, not for the 10 years that ended, in 2020 or 2021, or 20 years or whatever. But throughout market history, obviously that gave you a pretty big advantage, being kind of, at the end of the day, like the price, the price you pay matters. I mean, that's probably another thing that is a common mistake in poker, where like people will call. People just see things in like too binary of a situation. Like mm-hmm. People will call a raise with a hand where if you're playing let's say you're playing a 5-10 no limit game, typical raise is like $30, $30 or $40. Mm-hmm. But people will take a hand and they'll call the same raise. Like some people are like, oh well, I'm just either going to call or fold with this hand, whether it's $30 or $60 before the flop. And they don't really, you know what I mean? It's just like a little bit too binary of a situation, and that's another mistake people make, I think.
Oh, that's interesting. So they're not really focused on the payoffs on their money. They're focused on just yes or no, as opposed to the payoff function. Yes, exactly. Yeah, they're definitely not. And people will be slightly less likely to call a $60 raise versus 30, but yeah, not much. It's not as different as it should be. Like it should be way, way different, but it's not. That's interesting. See, my theory about a lot of investors is that the businesses they're invested in are often pretty good, but they're not invested at a low enough valuation, and as a result, they're not seeking high enough payoffs in order to offset being wrong. So you look at a lot of mutual fund managers who manage a lot of money and listen to their interviews, and they'll pitch something. Their best idea they think is worth 30% more, right? And that's a pretty low payoff. If you're 30% isn't, you need to be hitting that every time. You have to be right on that 100% of the time. It should be worth 30% more, and then you're going to put up good returns. But if those are your best ideas, that's You're kind of structurally under
Yeah, I mean,
seeking that.
and I mean that obvious like that way of thinking was obviously rewarded pretty heavily up until this year. You know, like I can't even. Someone someone blocked me on Twitter actually because he had a thread. He started a thread. It was like this was definitely like towards the end of 2021, where it was like, oh, list like all the lessons that you have learned like in investing or something.
Mm-hmm.
And they were just a list of like, okay, it was like only none of it had any. I mean, like some of them were like, oh, never, always invest in great businesses, never like go for like mediocre business. It was all stuff that like you hear at the end of like a bull run for growth stocks and like a giant bubble. It like literally nothing of it had anything to do with price. It was all like all the lessons were like ignore price, don't invest in mediocre businesses, only go for the best businesses, never sell any stock no matter what the valuation is. And I like typed in, I was like, this thread is like a list of all the things that people learn like in like an uninterrupted bull market,
right?
Like are at the top of a bubble or whatever. And yeah, the guy blocked me.
It's true though. He's basically curve fitting the last 10 years.
Well, it's so hard because I mean, I don't blame people. Like a lot of, I have good friends who are investment managers and are super smart and are conscious about price, like in general.
Mm-hmm.
But it's so hard to take like an idea. It's so hard. I mean, it's also a fact that people do tend to sell too early. Like that's not like that is like part of the like this bias called like the disposition effect is holding on to losers too long and selling winners too early because your mind views it as like a binary thing. It's either like I like if I sell a winner, I like won. Like I have like a notch on my belt that like I was victorious. I have a notch on my belt, and so people tend to sell winners too early. And to counteract that, people had this mantra of like never sell, and then and that's generally like more true than not, or it's like a valuable heuristic to try to remember. Like, okay, I try not to sell too early, but then that strategy was just rewarded so heavily for a decade that, yeah, I mean. You look at like Tiger Global or something like the idea of them, pulling the plug on that was just so difficult. And you didn't see really anyone like, I don't know if you found this, but I was like, for a while, I was like, trying to figure out like, has anyone made the transition from like tons of people between 2013 and 2020 made the transition from like more traditional value to like quality and compounders and whatever.
Oh, so many people.
It's like so many, but did anyone actually in 2021 say, fuck this, I'm out. It was a great run. Like the valuations now are insane. Like let's get back to just buying like things that are super cheap. I don't think anyone did that.
They never do. It's like people can't do it.
Yeah.
Once they change, they don't change back. Well, go ahead.
And it's like part of it is because it just feels better to own like quote unquote good businesses, right? Like you just like from a business standpoint, there's just less it's less likely that like something hits you out of the blue in terms of the business. But what you're always forgetting until it happens is something can hit you out of the blue on the valuation where it's like very minor for the business, but if the valuation gets to 50 times earnings, like you can just wake up the next day and your stock can be down 50% without any like reason for, you know what I mean? Without any like discernible reason. So yeah, like no one pulled the plug on it, I don't think.
Well, that's why I think it's interesting. I guess that's why I find poker interesting in terms of its applicability to investing is that poker is very situational. And I'm a terrible poker player, but I just find it intellectually interesting. But investing, what's that? Go ahead.
Yeah, I was gonna say the one thing about poker is it is situational, but a little bit less than actually significantly less than investing because there's while there is like different certainly different like table dynamics and you get like a crazy guy that comes in that changes how other people play and that changes how you should play and whatnot. The factor of like like cyclical things in the market, like starting valuations, for example, for like growth stocks versus value, or like US versus international, or like dynamics in different industries that sort of have these like 10, 20, 30-year cycles, is actually one of the things that I think makes investing so much more interesting than poker. Because like at the end of the day, yes, you have to react to what other people are doing. Poker is still like, it's 52 cards like dealt out in a random, dealt out randomly, and then the flop, turn, and river. Like it's the same game for every hand. Whereas in poker, like it's really like investing in 2022 is completely different than investing in 2020 because all the prices are changed.
It's yeah. So something I find interesting, I think everyone to a certain degree is just a momentum investor, where what has worked, it's so hard to come off that. And what you see is a lot of people who aren't like that, people who are deeply contrarian, they really get nailed. And often they're wrong. I have a little bit of that streak in me, and all it does is cost me. It's sort of like I was worried about valuations 5 years ago, right? Like a lot of people. And it really, if I had gone to cash, if I had tried to short based on that, I didn't do that. It's not something I'm good at. But if I tried to do that, I would have gotten crushed.
Yeah. Yeah, I mean, you look at what happened to like David Einhorn's returns, right? Where he was long, kind of like deepish value for a long time, and yeah, he did exactly what you're talking about. Like in 2016 or whatever it was, he built like a basket of shorts of like Amazon and Netflix and things, and he got annihilated. I mean, for me, what has worked for me, and it's it's only been 6 years running our 6.5 years running like our company and our strategy, but like what's worked for me is like any like impulse I have to do something like that, I like try to wait until it's absolutely like I even for things that like on the long side that I'm buying, I try to just wait until it's like hitting me over the head. And even then sometimes I'm too early,
Right.
Like
that's interesting. That's a good impulse.
And I do try to do that with selling things as well. But like we actually were, we always said it was long short, and we had a couple shorts, but we never had like a material short book for the first like 5 years. First like 4.5 years. And then in late 2020, I was like, this is just, it's so ridiculous. All the shorts are like in 6 feet under the ground. Everyone says you can never short something based on valuation, blah, blah, blah. And there was just so many companies that it was a combination of a valuation short and, just like insane. There was just so many insane business models, that I couldn't help it. So I tried to wait. And even then it was like a year too early.
Yeah. And so how did it play out? Did you wind up coming off it and sort of reducing risk?
Yeah, I mean, so we're up like 20-something% this year.
Oh wow, nice. That's a lot.
And part of that was we came into the year with a short book that was like 40% of NAV or something, and it's all down like. It's all down like 50 to 80% or something, because they were just, the valuations were, whatever, the NASDAQ is down like 20 or 30. And then, these stocks are down like 60, 70, 80. So it definitely helped us a lot this year, but it did the beginning of 2021 was brutal, right? Because, if you're shorting based on, that's one reason why people don't short based on valuation, is because, 2x rationality is really not that different from 4x, from 4x like a rational price. And I think you saw that in early 2021, and that was definitely, luckily for us, like our longs were making money during that period. So it's like we weren't, we weren't like losing money per se, but it did get pretty weird with some of the shorts for sure.
Shorting's tough. It's one of the reasons why I don't do it. I'm just kind of a type B person. I don't want to log in and check things a lot, and it just in a bubble, that risk of things just going up and hammering you, it just scared me so much, and I didn't want to actively monitor it. I wanted to be able to I would never set it and forget it, but just have that option, have that kind of built in.
For it definitely, anytime you have a short position, it probably takes up more of your mental space per like dollar per like NAV dollar than like a similarly sized long position.
Yeah, I hate that. I don't want that.
For
It
the
seems
simple
hard.
fact that for the simple obviously like if it moves against you 50%, it's getting bigger, and you have to think about like am I gonna cover it or not? And so it's definitely you have to weigh that whether you want to be like worrying about that.
I just want to close the loop on. I can't believe I just used that phrase, but on this whole evolving as an investor, how all these investors
Sure.
have taken the last few years and they've evolved, or at least think they've evolved. Yeah, I'm curious. There's a quote from Dan Cloud, who ran the Firebird Fund. He invested in Russia and made something like 50x his money for both himself and his investors. But he has this great quote that I want to read. Like boxing and poker, capitalism is a soft, restrained, private form of warfare. Military strategists have known for centuries that there is and can be no final science of war. Now, I'm curious, do you feel like that seems true to me?
That I think is definitely true. I mean, it's like any strategic game where you only outperform the market based on the mistakes of other people, really.
And they seem
Like
to be consistent over time.
and well, I think the mistakes are consistent over time, but like which ones are more prevalent, or like how they manifest themselves in like individual, like the valuation of industries or types of stocks, I think that changes. But yeah, I mean, fundamentally, the human brain is, it's certainly not evolving at the pace that markets evolve, right? So
Yeah.
I think people are always out there making some type of mistakes, but yeah, I mean, so I do think you can like try to systematically exploit the mistakes of other players. I mean, it's really the only way, I think, to like to beat the market. Like if you look at, I'm sure momentum investors would say, the consistent, and I mean, obviously momentum investing has a pretty good track record, like on a quantitative basis, like going back.
It's very seductive. It seems to all quants, even value investors who are quants, they have to add this momentum overlay to their strategy. There's so many people who've done it. I don't think it works. But it's interesting how they all get seduced by it. But sorry, go ahead. I interrupted you.
Yeah, the psychological underpinnings of why momentum would work, I think, are less appealing to me. I don't want to say less robust, because that's like almost like a reference to data, but like this kind of makes a little bit less sense to me, just because of what we were talking about earlier, where like the things it feels good to invest in something that has momentum.
Mm-hmm.
So it wouldn't really make sense to me that was systematically underpriced. But I think on the flip side, I think what momentum investors would say is there is that human bias towards, like that I mentioned earlier, towards selling things too early, and also not updating your information. Like there's the it's not really a sunk cost fallacy, but maybe it's a recency bias, but people do. It's an anchoring bias, perhaps, where people get anchored to the price they pay, and they just see that the stock is up 30 or 40%, and they're like, well, I'm just going to sell because I made money, not really like thinking like, okay, like now what's the new situation, like, and like update all of your information. But it's weird, because then there's definitely the desire by other people to like invest in what's hot, which I would think would kind of counteract that over time. Mm-hmm. So yeah, I trust momentum definitely less than I trust value, for sure, in terms of psychologically.
By the way, in terms of that cognitive bias that you mentioned earlier, where people sell their winners too soon and hold on to their losers too long, I feel like all the mistakes you've been describing are things that I do. It's been making me kind of laugh at myself internally.
I think everybody does them. I think if you're aware of them, I mean, actually, the data shows that even if you're aware of them, you still make them. But I think the only thing you can do is like what I do as far as like modeling a company. If it's something that we own that's working, I will try to give the company credit for what's going right and how I'm modeling it, and like try to like, because I know like my bias will be to try to sell it, because like I've made money. Obviously the stock is up versus where I bought it. Like my, or whatever my original model was, probably didn't think it was undervalued at whatever this new price is. So that's like probably my bias. I think probably all value investors have that. So then I just try to, in the model, I just try to give them, tons of credit. And I think I try to do reverse when something's not working. I try to like make sure I'm taking into account whatever bad things have happened. But it's so hard, right? Like I actually wrote a blog post about Tencent Media, which is Tencent Music, which is the TME is the ticker, but it's Tencent like spun off music business in China.
I read that quickly. That was something I looked at a year ago. Everyone thought that it was going to be this cash cow, and it seemed amazing. I happened to pass for whatever reason. What was your experience of that?
Well, the underlying business is a good business. Well, there's actually two businesses. One is like a Spotify like thing where they're just selling subscriptions, and I think they have a pathway to growing that business a lot over time, just because like right now only like 10 or 12, like 12 I think % of their subscribers are actually on the paid tier, but because they weren't really trying to. There was like a belief for a while, I think, that it was going to be really hard to convince Chinese consumers to actually pay for music. But they've been growing it, and I think eventually they'll reach much higher levels of monetization. And then there was a separate business which is essentially like a live streaming like karaoke, like it's called like social entertainment, but the app is called WeSing, and there's a couple other apps that they have, and my theory was basically, if you looked at the valuation on like the WeSing like karaoke live stream business, if you looked at the valuation based on that alone, it looked like a pretty, it was like trading at like 10 or 12 times earnings on those earnings. And then if you add on the ability to to continue to increase the monetization of the Spotify like business, that I thought they'd be able to grow their profits over time, and it looked undervalued. And then eventually, I after a few quarters, they really started struggling in the karaoke live streaming side of things, partially because TikTok, which is it's ByteDance's, their Chinese app is called Douyin, I think, and that business was taking a lot of users away from, because it's also like they have a live streaming segment that was just sucking the air out of the room in China, and so the business that I thought was going to like support the valuation was starting to crumble, and so the stock went from like 7 to 4 or 6 to 4 or something, and I wrote this blog post about like why I was selling it, and people were like, it's funny because people were like, oh, like on Twitter people were like, oh, it's so good to see someone, talking about their mistakes and being so honest and blah, blah, blah. And I was like, okay, like, yeah, maybe. But it's like, it's good to admit when you think you're wrong. Right. But then the sick thing is you can be wrong about being wrong.
Oh yeah.
Right.
Oh yeah.
Like the stock's at $7 now. Right. So, if I had just held on, I'd be up like 70% from where I sold it. So that's the sick thing about investing, is you never know. You can like admit mistakes or whatever, but you never even really know if you were wrong. Like that's the crazy thing.
Right. And then it's so much worse. I've submitted write-ups to Value Investors Club, and someone will point out something that seems wrong, and I'll admit a mistake. And then someone else will chime in and point out that the person's critique was wrong, and that what I initially had was right. And then I just shut up, and I'm like, okay, I'm a fucking idiot. and my credibility is just shredded. So basically, whatever criticism you level my way, I just kind of cringe and take it. I hate that. So now when someone gives a criticism, I'm very slow to react or anything.
And it's so. I mean, the world of probabilities is so strange. Like in the Twitter merger deal, which we were pretty publicly like long the stock, and like we thought it was going to close, etc. And obviously that worked out, right? It closed the deal. It was a good investment, whatever. And if you look on Value Investors Club, the people were bringing up like possible reasons why it could break. And like, honestly, I thought they were all bullshit. Like, if you just look at one guy was one very smart guy was talking about the banks are going to pull the financing, and
oh my God, I remember this. I was reading that thread,
and the number of times that banks have actually pulled financing on a deal like that when everything else is ready to go, even in the financial crisis, it almost never happened. Even the canonical case where it actually did happen, which was with the merger of or the buyout of Huntsman Chemical Company.
Mm-hmm.
The banks pulled their financing, but it was actually only because the buyer tried to change the terms. And then the buyer claimed that the banks were pulling the financing, but really they were still willing to finance under the original terms.
Mm-hmm.
So anyway, people were saying these things that at the time they were like, oh, maybe that makes sense. And I thought, and then it's like, wait, but actually I thought it made zero sense. And then it never actually came up. But even then, you don't really know. Maybe there was a 30% chance that the banks tried to pull the financing, and so it's even doing a post-mortem is so difficult in investing because there's no counterfactual. You don't really know you can never know the odds of the actual situation.
Someone once asked me. I did some work for a professor at Columbia Business School, and he had me work with someone else there on a database of investor mistakes, and I just didn't like the whole project because you couldn't tell how often the thinking or the process behind the mistake actually worked. So
right.
If it's someone, so we covered Charlie Munger buying court furniture, and it was, well, he did this wrong and that wrong. And I was like, well, did he? Because when he does this most of the time, he's produced, even independent of Warren Buffett, he's produced 15% a year on his capital for the last 60 years. So is he really the one making the mistake, or are we just a bunch of whiny assholes, going through this and being like, oh, you got court wrong?
It's and actually there's a lot of parallels to poker there, because people think in poker, one I guess another common mistake people make is they worry more about the actual what actually happened in the hand rather than the probabilities about possible things that could have happened. For example,
oh yeah.
For example,
that's everywhere in life.
It's everywhere in life. Yeah, I mean the most egregious example in poker is when people they get all their money in with a good hand, and the cards and on the last the guy just has a flush draw or something. On the last card, they get all the money in, they're winning, and then the last card hits the guy's flush, and they'll be like, "Oh!" I mean, most people that play at decently high stakes are smart enough to know that they had an 80% chance to win,
right?
Or 85% chance to win. But there's even some players that don't even understand that, where they're like, "Oh fuck! I made a mistake. I shouldn't have done that." Blah blah blah. But then 3 steps upstream, people also don't really understand if you let's say you have pocket queens and you get it all in pre-flop and the guy ends up having kings or aces. I mean, that doesn't really tell you whether that was a good play on your part. Most players will feel like that was a mistake because they got it all in bad, but it's entirely possible that this kind of player that you were playing against could have had aces, kings, queens, jacks, tens, ace king, ace queen, garbage. You know what I mean?
Mm-hmm.
And so people are just very very focused on the outcome, and it's just much harder to take a step back and really think about what the probabilities are, which is exactly what you're talking about. Court furniture, I mean, okay, it didn't work, but can we systematically test the way that his analysis worked on other companies? I mean, and like you said, probably the best way to do that is just to look at his returns over a long period of time and okay, it seems like that type of analysis, maybe it does work.
Yeah, it's like Ted Williams. I remember reading his book about hitting, and it's totally probabilistic. I'd never
Yeah.
heard of such a thing in my life. I'd never heard someone, actually, one other time, I had a lacrosse coach who would sort of say, here's your error. Here's where you can allow the person by you, but you can't allow him by you on the front side. He could, if he goes back, then that's okay. We'll give him that shot, but you can never allow him to beat you on the front. And it was sort of like, okay, now I know how to prioritize, as opposed to just saying, well, never make a mistake.
Yeah, that is interesting. I mean,
Hold on one
yeah,
sec. I just got to.
I'm trying to think of if oh yeah. Wasn't sure.
Sorry about that. My cord fell out.
Yeah. No worries, no worries. Um, yeah, like and I think that is also true in investing. I mean, I don't know how like more growthier investors kind of look at that, but I mean, um, my style of investing, that maybe the biggest similarity is like, okay, I might, make a mistake in terms of, my analysis of the business. I mean, I spend all my time trying not to, but I'm never going to just like buy something that is just straight up like super overvalued, even based on like what they've done historically. You know what I mean? So I'm personally like, that's just not a mistake that I'm going to make. Maybe things change in the future and I end up being wrong, but like, I'm not going to buy something at 10 times sales and be wrong on that end, because I think that's just it's the same thing in lacrosse. Like, it's the type of mistake where if you consistently make that mistake, it's just going to hurt you a lot more than other types of mistakes, I think.
Mm-hmm. I find it very interesting that you went to MIT and you clearly have this mind for I would assume math,
Yeah.
and yet you're not a quant. I find that very interesting. Clearly you believe that there's a deeper reality than that captured by data.
Yeah, I mean, I think that and at our firm we do have some quantitative strategies, although I'm not like the main point person on them. But I think there is some value to be had in, like, I think in investing, like, a lot of the stuff is still squishy enough. I don't know if that's the right word. That some you can add some value by combining sort of a quantitative way of looking at the world with an appreciation for, like, not all data can be quantified.
Mm-hmm.
Like in investing. I mean, a lot of it can, and I think you can do pretty well with with a quantitative only strategy. But I think especially if you're combing through, like, because I mean, there's just thousands and thousands of securities out there, right? So, like, I think one smart way of looking at the world these days, when there are so many quant funds out there doing good work, is to look for those situations where the numbers don't quite tell all the story.
Mm-hmm.
Like, and I think that's the it is a little bit of a weird niche, though, to say, okay, I'm respectful of the fact that the numbers tell a lot of the story, and so I want to fish in a pond where the stock is not super expensive, and the numbers generally look good, but where I think I am able to add a little bit in terms of, like, it might just be like in a situation where, like, the accounting, I think the accounting, like, doesn't quite capture the the economics of the business or something like that. Like, situations where quant funds might, like, make a mistake. I mean, that's I think potentially a spot where you could hit some home runs, is like finding a situation where it's still it's somewhat cheap on the numbers, but you can see reasons why both the typical sort of qualitative investor might make a mistake, or just ignore the company because it's, like, too small, or it's, like, maybe in, like, a sin industry or something.
Mm-hmm.
But then also where, like, the numbers, like, don't quite tell the whole story. I think you can find that's, like, a good pool to fish in, for sure.
I'm curious, what was it like being a professional poker player? I had a friend who was
It
a pro golfer, and he was like, it was crazy. It was just, it was whatever the worst things you think it was like, that's what it was like. It was just this crazy debauchery. It was exactly,
yeah, I
it
mean,
was everything you'd hope it would be. Is that what it's like,
playing
pro poker?
playing poker is very strange because it's I mean, imagine if in golf, because like being a professional golfer, you have a very like kind of finite path to making money playing golf, which is you go through the qualifying system, you get your card, you go on tour, blah blah blah, and of course there's like there's like lesser leagues and stuff. It's the same thing in most sports. Like I played tennis, and yeah, you play futures tournaments, and then you get it. Hopefully, you get invited to bigger tournaments. But like, imagine if within like every major city there was like 2 or 3 places where people were betting thousands of dollars on golf like every single day, and there was no handicap. Right? Like that's what's going on in poker. Like I can drive half an hour and be at the MGM casino in just over in National Harbor, like just over the bridge in Maryland from DC, and yeah, there's like 20 tables going, and people are sitting down with like $2,000-$4,000, and some of them are good players, but a good chunk of them are terrible. and there's no handicap system, so you just go in and like, I mean, the beauty of poker though is unlike golf. I mean, golf, it would be so obvious that no one would play with you, right? Because they would just lose every time.
Mm-hmm.
And so that makes it seem like poker would be a worse thing to be a professional at, because sometimes you lose, right? Or sometimes you could lose for a month or a week. Or I mean, a month is tough. If the players are bad, a month is probably unlikely, but a week for sure.
How long would it take you to figure out whether someone's a good player or not?
So it's a little bit like tennis or golf, where the higher you go up the quality level, the longer it takes.
Mm-hmm.
But you can find out if someone's bad very quickly. So like in tennis, like so I played college tennis. Like at a high level, like I can't necessarily, I definitely can't tell the difference between like a good player and a great player based on like one shot most of the time. I mean, you watch Federer for a couple minutes and you're like, okay, this is like a different level.
Right.
But for the most part, it's not so easy. But if they make one really bad mistake, then you can be like, oh, okay, I wouldn't see, a good player doesn't make that mistake.
Right.
You know what I mean?
With a really bad player, you could probably tell just by how they walk and hold the racket.
For sure. Yeah. By a bad player, you can tell just by the fact that their bag doesn't have space for more than one racket. Like in tennis, because like if you're hitting the ball hard, you need like at least 3 rackets to be strung before you play a match, because you might break your strings. So you can tell just by the bag.
I don't even have a bag. I would literally show up and just look like a middle-aged man.
Yeah. Although, I mean, you will see players, who knows, you will see players just rolling up with no bag and a few rackets. But so yeah, in poker, I mean, you can tell, like, I mean, but in poker, it's weird because you don't get the cards don't get flipped over that often, right? So, you can't necessarily, like, people are betting and raising, and you don't know, they could be doing something crazy or they could be doing something smart. It's not until you see like and of course, someone will have aces and like most people would play aces like kind of similarly, like you raise. If someone else re-raises you before the flop, you go all in.
Mm-hmm.
It's not that hard to play. It's like those a little bit trickier situations where you kind of find out, how good someone is. I mean, it's similar to investing, like you were saying earlier. You were reading, sometimes you'll read like a write-up that someone does, and you're kind of like, yeah, maybe this is not the person that I want to like spend a lot of time like listening to or whatever, or like reading their other stuff. You can kind of tell pretty quickly.
Right.
But at the highest level, even people doing like really good write-ups, you might not find out for years whether they were, first of all, right on that idea, or like, does their portfolio make money over time? Like, even like, that's the crazy thing about investing. Like, I'm 6 years into to starting our firm, and like we've had good results, but I tell people, like, I mean, there's still like a 50% chance it's like luck, right? I mean, like, who knows? You know, like it's so hard to it's so hard to like suss out true talent in this industry more than anything else in the world, probably. I mean, I don't know.
The randomness is enormous, but yet it
Yeah.
is not. I just don't buy that it's 100%. I don't even buy that it's 80%. I think it's more like there's 60 to 75% randomness in it, and it's just, and it can go on for a long period of time. It's kind of like what we were talking about, where these people who are value investors evolve. And
Yeah.
and it's sort of like, I guess what I find disappointing about that from a kind of a quantitative or a probabilistic perspective, or the perspective of someone who truly believes in value investing, is that I just don't think it's good empirics. It's right. They're just chasing what's worked in the past and what's cool, which is the exact opposite of what you should be doing. And when you look at a lot of those people today, a lot of it has come back. It's mean reverted hard. I'm shocked at the speed with which it's mean reverted, considering the broader market has barely corrected.
And it's so interesting because this like bear market, or this like bubble popping or whatever, is like so exactly the way it happened in like 1999 2000. It's crazy.
Yeah.
I mean, not 100%, but and the funny thing is, we are everyone in 2020 and 2021, they all knew, like, a lot of the investors, every one of them knows about the tech bubble. You know what I mean? Like,
most of them have lived through it.
Yeah, and most of them have lived through it, and it still did exactly. I'm like shocked by how you know, quickly, and I think even a lot of the really crazy stuff corrected like almost even faster than it happened in the tech bubble. But yeah, and it's just something about human nature, I think. And I mean, never again will I ever let someone get away with like saying in public that like, oh, valuation doesn't matter, or, you know what I mean? Like, I was quiet for so long, like on Twitter and stuff, and now I just feel like I just can't. Like, I'm never letting that slide again.
I'm obsessed with this concept. This philosopher Friedrich Nietzsche, and actually others have it too, but he has this concept of eternal recurrence, which is this idea that because time is infinite and the physical world is finite, that the same events happen over and over. And a corollary of that would be that human life doesn't really change. If you read Marcus Aurelius, if you read all these people who wrote thousands of years ago, they complain about the exact same things we complain about. They feel the exact same pain and anguish and hope and happiness that we feel. It's remarkably similar. And so the stuff changes, the furniture changes, but we don't really seem to.
Yeah, and it you know, I actually saw some talk. It was actually Ricky Gervais was talking about why he's an atheist, and part of his argument was like, if religion ceased to exist, like the next incarnation of it would like probably be pretty different. Whereas like for physical laws, like for science, even if you throw away all of the science books, burn them all, in 1,000 years, the science books will be the same, because like those laws, you know, are like immutable parts of the universe, basically. And I feel like human nature is probably the same way, right? Like, you know, if you wiped all of our memories, like if you just, you know, canceled out all the books and everything, what people would be worrying about and feeling emotionally, and the things that they would be saying, and like, but, you know, and maybe it's the same way for financial markets, because at the end of the day, this is like a product of human emotion and fear and greed. Like, probably the way bubbles form and the way you know, markets work would be like the exact same 1,000 years from now, even if you blew up every single stock market in the world today.
That's really interesting. I think it's true. I think even if you wiped a person's memory, they would just be, if they acquired new memories and were able to function normally, they would be just exactly the way they were before.
But I wonder, this just popped into my head. If there was an alien life form with a different working brain, like, is there something about like the mathematics of like business, and I don't know, or like just the way, like, our fear and greed more intrinsic? Like, are they intrinsic to like the physical world even more so outside of human beings, or is it something? Probably. I mean, maybe aliens wouldn't have fear and greed, but I don't know. I'm not sure about that.
I don't know. That's interesting because you look at chimps; they have that.
Right.
They're just like us, that except to the extreme.
Right.
They're violent to the extreme.
Right. So
They're power
probably,
hungry to the extreme. They're screwing
right,
each
so
other to the extreme.
Yeah, so brains that evolved, even ones that evolved probably like outside of the our like direct family tree are probably also, yeah, like, do fish have like fear and greed and, like, you know what I mean, like probably some form of it, I don't know.
I would imagine.
Yeah.
I would imagine. Well, that's a good place to end. I promise to keep it to 45 minutes to an hour. I'd rather just have you on again than do 2 hours. But Evan, I really appreciate you making the time, and I'd love to have you back on if you ever have a chance.
Yeah, thanks, Scott. Appreciate coming out.
Take care.